7 Jewish money rules to never be broke again. Saving aggressively in a low-yield account is a strategic error. It prioritizes perceived safety over capital velocity. Your money is passive, not productive. So where should capital be deployed for actual growth? The conventional model of just earning and saving is flawed. Wealth isn't built from stored labor, but from deployed assets. The strategic approach involves creating systems that acquire income-generating assets for you. We're examining the frameworks that make this possible. Number 1. Separate emotional spending from strategic allocation. The principle is this: every dollar in your possession must have a defined function. Emotional spending, that's retail therapy, impulse buys, or upgrading your lifestyle the moment you get a small bonus, represents a critical capital leak. It's money that vanishes without a trace on your personal balance sheet. The common misapplication is operating from a single blended checking account. Your paycheck arrives, you pay your bills, and whatever remains becomes a vague pool for spending. This creates a reactive financial life where your strategic goals, like investment, are merely an afterthought, the leftovers from your emotional consumption. The strategic implementation is to adopt a capital allocation model immediately. Before you spend a single dollar, you assign its role. Create separate accounts or digital envelopes for specific purposes. One for operations, which is your monthly bills and living expenses, one for security, your emergency fund, and one for growth, your investment capital. You automate transfers to these accounts the day your income lands. Money in the operations account is cleared for spending. The money in the others is contractually untouchable for daily use. This system makes strategic allocation the default and forces emotional spending to become a conscious, limited decision. The payoff is profound. You stop fighting a battle of willpower every day and start operating a system. This creates automatic velocity for your capital, directing it toward assets before lifestyle inflation even has a chance to make its claim. Number 2, always have a secret financial reserve. This principle is about understanding that liquidity is optionality. A hidden financial reserve, separate from your main accounts and emergency fund, is your ultimate leverage. It helps you navigate crises, seize opportunities, and negotiate from a position of strength. Many people mistakenly treat their primary emergency fund as their only reserve. This fund is often commingled with other savings and known to you and your family, making it accessible for non-emergencies and vulnerable to depletion. The strategic move is to set up a separate, anonymous account at another bank that you don't track in your daily net worth. You fund it quietly with windfalls, bonuses, or side income. This reserve is not for emergencies. That's what your other fund is for. It's for strategic moves, a down payment on discounted assets, covering a gap when you leave a job to start a business, or walking away from bad deals because you don't need the money. This reserve shifts you from desperation to authority, enabling calm, rational decisions when others panic. Number 3, turn information into actionable intelligence first. The principle here is that raw information is just noise until it's filtered and contextualized for your financial position. The wealthy don't consume more news, they have better filters. The common mistake is reacting to market news, stock tips, and economic forecasts without a framework, leading to buying high on hype and selling low on fear. The strategic move is to apply a strict filter to every piece of financial data. Before acting, ask, what specific, actionable step does this information enable for me, given my current assets and goals? For example, rising interest rates are noise, but actionable intelligence might be, higher borrowing costs will likely cool the real estate market in my target cities, creating a buying opportunity. I will adjust my savings plan to accumulate reserve capital for this moment. You're not a passive consumer, you're an active interpreter of context. The payoff is no more reactive decisions. You'll be positioned to acquire assets when they're out of favor and the crowd is distracted by the latest news. Number 4, convert knowledge into a fee-based skill. This rule states that your highest value asset is a monetizable expertise. Turning what you know into a direct revenue stream creates financial independence from your primary employment. The common mistake is hoarding knowledge or giving it away without capturing its value. Most people rely solely on their salary, creating a single point of failure in their income. The strategic move is to audit your knowledge base. What do you understand deeply? Is it structuring deals, digital marketing, niche software, or a specific industry process? Package that knowledge into consulting, a high-value workshop, or an advisory service. Start with one client to validate that your knowledge has marketable value outside your job title. The payoff is creating a second, powerful engine for income that's often more profitable. It builds your professional reputation independently and gives you the financial confidence to take risks in your primary career, knowing you have a separate revenue stream. Number 5. Avoid partnerships where you supply only capital. The principle is straightforward. Capital is a commodity, but operational skill and execution are not. Entering a partnership where you only provide funds misaligns incentives and puts your capital at high risk. The common mistake is becoming a silent partner, where you supply the money but assume all the financial risk, while the operating partner, who has no capital on the line, lacks the same urgency to protect and grow your money. The strategic move is to contribute a critical non-capital function, like deal sourcing, governance, strategic oversight, or leveraging your network. If you provide the majority of the capital, ensure your partner has their own money significantly invested for true alignment. Additionally, structure the deal so your capital is secured by hard assets or a preferred return, meaning you get paid back first. The payoff is shifting from a passive investor to a protected principal. Your capital is secured by both legal structure and operational involvement, reducing your risk of total loss and transforming the partnership into a true collaboration. Number 6. Renegotiate every fixed expense relentlessly. Your most powerful wealth-building tool is your gross margin, the gap between income and expenses. Fixed, recurring expenses are silent killers of that margin. People often focus on one-time savings like grocery coupons, but ignore monthly fixed costs such as insurance, software subscriptions, and utilities. These aren't small leaks, they're compounding drains on your annual investable capital. The strategic move is a quarterly audit. Block time to call providers for insurance, internet, and cellular plans, using competitor pricing as leverage. For businesses, renegotiate software licenses, vendor contracts, and lease terms. The goal is to relentlessly reduce your baseline operational burn rate. The payoff is margin expansion. Every dollar saved from fixed expenses directly flows to your bottom line, increasing investable capital without additional work or revenue generation. It's the cleanest profit you can make. Number 7. Your reputation is your highest credit limit. This final rule asserts that in high-level finance, trust is the ultimate currency. A reputation for integrity, competence, and delivering results is more valuable than any credit score. The common mistake is focusing solely on optimizing your FICO score while burning professional bridges, missing deadlines, or being difficult to work with. People fail to connect their professional conduct with future access to capital and opportunities. The strategic move is to treat every professional interaction as a live audit of your character. Be ruthlessly reliable, under-promise and over-deliver every time. The person you deliver a project for today could be the source of a 7-figure deal tomorrow, because they have first-hand evidence of your reliability. The payoff is converting social capital into financial capital, access to off-market deals, favorable terms, and investments based on your word and track record alone. Bonus point: build a hidden cash reserve today. For those still with us, this final point is your direct assignment. We've discussed a secret financial reserve as a strategic tool, but the theory is useless without immediate action. Your bonus point is to build that hidden cash reserve, starting today, not next week, but today. This step separates theorists from operators. Open a new, separate account at a different bank from your main one. Do not link it to your primary banking app. Fund it with whatever you can, $100, $500. The amount is less important than the act of establishing the system. This account represents your first tangible step into strategic financial management and is the physical manifestation of your mindset shift. Thank you for sticking with me till the end. Write the words "capital reserve" in the comments below to signal you've understood this fundamental shift. These 7 rules form a new financial operating system. If this provided a clear advantage, please like the video. Subscribe to Kaifu for direct, actionable insights every week. Share this with one person in your network who operates at this level. There's another video on screen now that details how to structure your first asset acquisition. I will see you in that one.